Hello, and welcome to our first quarter strategy review for 2021. I'm sure there are very few, if any of us, that will mind seeing 2020 be behind us. However, it's turned out to be a relatively interesting year and, strangely enough, a positive year, which when we did our first quarter strategy review for 2020 and second quarter, we weren't at all sure that any of that was going to happen. But at our meeting, we did have, as we usually do, a guest. Actually, we had three guests that represented the Van Eck Management Company. Van Eck is a large mutual fund and ETF management company managing over $49 billion. And they specialize in emphasizing particular areas of the market and have been doing it going all the way back, as they told us this morning, to managing a gold fund even before it was legal for Americans to own gold. The reason that they joined us and that we invited them is that they do manage two funds for us in the portfolio. They've both added significantly to them, to our portfolio. And again, we're very happy to have them there to give us some broader insight on their specific funds and certainly about what's happening in the current markets. Also with me was Len Skeena, Vice President and CEO of the firm, and Bob Toomey, again, Vice President and Director of Research. Again, we covered a broad swatch of all the things that we do, as we always do at these quarterly meetings. There was some pretty good unanimity of thinking as to how we looked at the markets. But even with that, we still took as much time to cover the area. We even commented we were so close at the beginning. How did this session go on so long? But it did, and we do take it very, very seriously. So with that, I'd like to move on and ask Bob to cover the U.S. equity markets for us.
Thanks, Dan. So, as most of you know who follow the market on your own, the market has had an amazing recovery since the lows that we experienced in March. And I think that many people and many pundits back in the spring would have never thought that the market could recover as quickly and as much as it did between that low in March on March 23rd to where we're seeing the S&P trading right now, which is around 3,700. So it's gained significantly, over 40%, and one of the fastest market recoveries from any bear market we've ever seen. Given the economy and there's still a lot of pain out there relating to COVID and its aftermath, a lot of people, including our clients, are asking, how could the market be up so much when there's still so much pain and negativity out there? And part of that really is the fact that the market is a discounting mechanism. The stock market will look forward as much as it can to discount what it sees in the future. And by discount, I mean bring that future into the current price or the present value, if you will, of the stocks. And what it is doing is it's anticipating a much stronger economy in 2021. We see estimates of GDP growth next year in the range of 5 to 5.5%. It's also discounting, because of that, a much stronger growth for U.S. corporate profits. We think U.S. corporate profits will be up in the range of 25 to 30% next year. And so while that might seem sort of, I don't want to use the word heartless, as I said earlier, the stock market really discounts as best it can what it sees in the future, and really it's discounting a better future. And I'd say the other reasons as why I believe the market has been going up are very accommodative Federal Reserve policy, As you know, the Fed has stated it is not going to raise rates for at least another year or more. And they are also continuing quantitative easing. All of that is providing liquidity to the market and to the economy. We're also seeing very little sign of any significant inflation. We think there might be a little scare, a little pickup in inflation the middle of this year, but we don't think it's sustainable. We still believe that core US inflation will remain under 2%. And then, of course, low bond yields. Bond yields are at historic lows. There's very little alternative for investors outside of US equities to generate any kind of meaningful returns. One concern that I do have that we discussed in the meeting is valuation. And I've expressed this before in this call. The market is trading a little around about 22 to 22 and a half times forward earnings for 2021. And you can see in the chart that I'm showing here that PE valuations are elevated. And it raises the question, how much of the recovery for 2021 is already reflected in stock prices? And we believe, and we discussed this at the meeting, we think that some of it is clearly already reflected in stock prices. What we believe, though, there are quite a number of sectors, including, travel, retail, airlines, a number of sectors in the economy that are still way below where they were a year ago. And so we don't believe that the recovery in the market is complete. And that's what gives us encouragement that there is more upside for equities in 2021 and why we remain positive towards equities. As a result of the higher valuations, we are, however, maintaining a slight tilt towards value. And we believe that we can achieve that value through holdings like Moat, the VanEck Wide Moat ETF, and also through the REGL, which is the Regal Midcap Dividend Aristocrats. Both of those ETFs are focused on, will tend to hold stocks that have lower valuations and pay higher dividend yields. So we think that that's a way that we can hedge the concerns of over higher valuation. I'd like to turn it over now to Len, who's going to talk a little bit about international equities.
Thank you, Bob. The U.S. has definitely led this year with respect to which stocks have done better versus the international market. Nonetheless, international has done well, and we continue to expect international to do well. We are favorable on that area. Last quarter, we reintroduced emerging markets into our portfolio, figuring that that particular area will continue to do well as the Chinese economy recovers from its situation with coronavirus and as the entire world starts to recover. That continues to be our feeling, but we've taken it a step further this quarter, and we've replaced our emerging markets fund with a fund that's going to invest in emerging market securities, but in those securities that are exclusive of those that are state-run. So we're looking at the non-state-run businesses. And what that does is it allows us to get into businesses that are going to be run more efficiently than state-run businesses generally tend to be, as well as in industries that tend to be really more tuned towards high growth areas as opposed to the state-owned areas that are typically considered more mundane and not certainly the areas where you see innovation and high growth all of the time. With that, we are expecting it to add some additional element to our international. And so we're allocating what we had been looking at as our emerging markets now in that area, and we're expecting to see some additional kick in the portfolio as a result of that. With that, I'd like to turn it over to Stan to talk about REITs.
Thanks, Len. Talking about REITs, again, we continue to favor REITs because of their very high dividend relative to other securities. Remember, REITs are a pass-through. They must pass through 95% of everything they earn. However, for the past few quarters, and frankly, including this quarter, we are concerned about the fact that traditional REITs, which is what we primarily own, are made up of three primary investments: large shopping centers, commercial buildings, and large apartment houses. All three of these have been experiencing some problems because of the pandemic. So we have been trying to diversify away a bit from them. And last quarter, we purchased a industrial REIT, which invests primarily in industrial properties. And this quarter, we're going to go back to investing in a REIT that invests primarily in medical properties. We again are looking for a little more diversification. However, interestingly, the markets have not treated REITs that badly, and they had a pretty good quarter overall. So we're pretty much continuing with a good exposure to the REIT area. We're adding the medical properties this quarter, and the medical properties, by the way, does pay a very high dividend. So it fits nicely into what we're trying to accomplish in the REIT area. With that, I'd like to turn it back to Len to talk about fixed income.
Thank you, Stan. On the fixed income side, we really expect interest rates to remain low. The Fed has made it very clear that they have no real desire to raise interest rates, and they're not going to do anything about that for the next year or so. We see the market perhaps affecting the long-term curve a little bit, and if it's going to do that, then it may push long-term rates up a little bit from where they are. But overall, we're not anticipating large swings in interest rates, and we're anticipating that things are going to continue to remain low. For that reason, we're continuing to not really emphasize fixed income very much, but where we can, we're looking for some additional growth or some additional yield, I should say. And with that, what we have done is continue to kind of supplement the intermediate term area with a global bond fund that is paying a much higher rate of return than US treasuries are paying right now. This additional income is coming in a way where it's actually simulating high yield type returns without subjecting us to the same level of risk as high yield funds would subject us. That has been a winning combination for us so far in the last few quarters, and we're going to continue with that. With that, I'm going to turn it over to Bob to talk about changes in our holdings.
Great. Thanks, Len. And as you know, Len did a nice overview of our new holding in the international area, the XSOE, which is going to be replacing EEM, which is the emerging markets. And I think it's a great change. There's a lot of research that shows that non-state-owned enterprises, particularly in China, and that's what this reflects, have done much, much better over time than state-owned enterprises or enterprises that have a very high involvement of a state-owned controlled authoritarian type government. So, you know, we think this is a great change, and we believe it's going to benefit all of you, all of us in our models going forward. Overall, we did increase our equity exposure slightly by about 4%. This was done largely because of increase in our U.S. large cap holdings, and also slight increases in those two value-oriented ETFs that I mentioned, MOAT, which is the VanEck large cap MOAT stocks, as well as the mid cap dividend aristocrats. We raised our allocation to commodities also very slightly by our increase in GUNR, which is the commodity ETF that we use. We think that with some acceleration in economic growth and higher, potential for somewhat higher inflation next year, that commodities should do better in 2021. And GUNR is diversified across a number of sectors, including energy, agricultural, metals, precious metals, and timber and forest products. So with that, I believe that gives you a good overview of the changes in our holdings, and I'll turn it back to Stan for closing comments.
Thanks, Bob. And thanks to all of you for your comments. My final comment shows that we've got a bit of a dichotomy in terms of what we are afraid of and what we are looking forward to. There's no question that we are looking forward to an end of the pandemic, a successful implementation of the vaccine, and the pent-up demand that you might have for many industries because of that. As you all remember, we do set triggers for ourselves so that in the cold light of day, we can recognize something so we can make a quick decision. And we talked about it a lot. We're all, of course, in favor of and looking forward to the vaccine. But we said if there was some shock in terms of the delivery of the vaccine, in terms of the efficacy of the vaccine, in terms of the acceptance of the vaccine, and we did talk about it a lot. The question was, how do you identify that? We think we'll know if it happens. And again, it's a trigger. We don't think it's going to happen. So again, generally speaking, a shock in the delivery and the acceptance of the vaccine would cause us to take action to reduce our positive exposure, especially to equities. The other one we said, as I say, it's a bit of a dichotomy because on the one hand, we're saying we think things are looking really good, but we're frankly money managers. And in this case, we're a little afraid of it being too good. So we're going to watch, and on your screen now, you'll see a chart of the 10-year Treasury bond, currently trading at a very, very historically low rate of under 1%. We, just to be sure, and again, we don't expect it, that's why we set triggers, we don't expect it, but just to be sure, if that 10-year Treasury bond traded up to the 1.3% that you can see on the chart occurred pre-pandemic back in February, we would take that as a concern that there might be some action, Federal Reserve, whatever, which would also cause us to take some funds off the table, probably in equities and certainly in bonds. So those are the two triggers. Again, we are hoping and not expecting either one to go into effect. Therefore, we are expecting a positive quarter, as I think you can see. And I'd like to say thanks for tuning in. Look forward to having you join us again for the second quarter of 21, and we'll even have more of 20 behind us by then. Thanks again.